Today's data feed from China was a bit of a mixed bag, some pluses and certainly some big disappointments. With me down the line to try and make sense of it all is Barclays senior regional economist. Why an encouraging performance from factories where output for July met market forecasts was offset by less buoyant activity for investment and retail sales, where growth was not as strong as expected, while the cooling property market showed further signs of deterioration. But what was your big take from today's readings?
Well, it's a classic tale of two halves, and that while the export-led manufacturing sector is picking up traction in tandem with the U.S. investment capex cycle, I think the domestic story within China remains clearly more muted. And a big part of the sluggishness is found, as you rightly pointed out, in the real estate market, which has slowed new loan creation, construction activity, and also retail sales.
The further signs of softening in July came despite a burst of government stimulus measures. To your mind, does this suggest more policy support may be needed to keep growth on track?
Yes, I think the stimulus measures to date have been given out in very small doses, and they were targeted at ensuring credit flows into smaller companies. This suggests that there's probably more scope for broader measures like rate cuts to help stimulate domestic demand, to keep growth momentum at 7.5% full year. And we expect the PBOC to cut rates shortly in both Q3 and Q4 this year, so 2 rate cuts coming.
Accustomed to vigilantly watching for signs of excessive debt, observers of China's economy may have gotten a shock due to credit creation data. Do you think the slowing in investment is linked to concerns over the Chinese shadow banking system and fears of a collapse?
No. While I think it remains a risk in the background, I think fears of a collapse in the banking system have been quite overstated. While debt is high, let us remember that the pools of private savings and corporate savings in China are also very high. So that itself is an offset. Credit creation, we saw today, has slowed in July and is likely to slow as well in the next few months at a more measured but sustainable pace. So I think all in all, we're settling down to a slower state of growth, and that itself would take some of the risk out.
The PBOC is not known for having the fastest reaction, but immediately after the data flow, they put a note on their website saying slower credit growth in July is in a reasonable range. Do you agree with the PBOC's views, and could the speed of the response be indicative of the realisation in the drop in sentiment towards the economy?
Well, they're not perfect like all central banks, but to its credit, I think PBOC has been sufficiently proactive in flagging the risks and delivering measured responses in terms of selective stimulus. I think it's adopting what we call an incremental escalating strategy. So as the data worsens, as the risk pick up, it will deliver more and more stimulus. And I think today's response from the central bank, as well as the data, is an affirmation of our views that more policy easing is probably warranted in the second half.
The PBOC said their stimulus will not be US style. With that and all that we have discussed in mind, what is your outlook for the dollar yuan over the coming months?
We think it'll have a stronger bias because with the widening of the trading range of dollar CNY, I think the currency will be driven more by data releases rather than by the daily fixing. So as the country then continues to report monthly trade surpluses, as long as this continues to happen, I think we can expect a steady drift in dollar CNY lower, and we're expecting a drift towards 6.15 by this time next year.
Wai Ho, thank you. Viewers, thank you for watching, but don't forget today we also have our press review and forecast programme, so please do click back for that. Goodbye for now.